François Rochon from Giverny Capital just released his last annual letter, and in this video we'll comment on it because it had some very good advice to manage your own portfolio. You will see as well his performance, because since the last 30 years he's been outperforming the market, so we can get some very good advice to manage better our portfolio and to be better investor for the long run, and particularly if we want to beat the market. So the first thing that I highlighted is first the Rochon Global portfolio. Okay, the returns since July 1st, 1993 are crazy. Okay, it's annualized 15.1% compared to 9.8% for the index. So the index is an adjusted index with Canadian stock, world stock, and so on, but still 15.1%, which is better as well than the S&P 500. So you can see here, if you invested $100,000 in July 1993, you will have $8 million now instead of 1.4 million if you invested in index. This is the second one. It's a US portfolio doing 14.1% compared to 10.6% for the S&P 500. In 2024, it did 17% compared to 25%. So it outperformed by 8%. It underperformed, sorry, by 8%. You can see that it's not the only year it's been underperforming by a few little percentage points, but on the long run, he's outperforming. You can see as well for this one. For this one, he's been underperforming by 2% last year. So he's not. You need to understand that you will not outperform the market every year. Okay, Warren Buffett didn't outperform the market every year. There is no fund manager with more than 10, 20 years of history in their portfolio that are outperforming every single year. But on the long run, it's outperforming. And then on this last portfolio, the Canada portfolio, he's been actually outperforming the market by 1%, last year by 20%, the year before by 4%, so steady outperformance, and annualized since 2007 plus 17% compared to plus 6.8%, which is really big outperformance. Here's some stuff that I highlighted that I think are interesting. It was once again the year of S&P 500 mega cap, so-called Magnificent Seven, returned 48% and now represent more than a third of the index. These 7 companies contribute to half of the S&P 500 gains in 2024. In fact, S&P 500 stock on an equal weight basis, not weighted by market capitalization of each company, generated 13% in 2024. So it's crazy to see that 48% of the S&P 500 was the performance came from 7 companies. So when people say, oh, I'm diversified because I own a S&P 500 ETF or index or whatever, finally, they are not that diversified. Okay, the top 4 companies in the S&P 500, so Apple, Microsoft, Nvidia, and Amazon, trade at an average of 33 times expected earning for 2025, so forward PE, compared to an average earning ratio of 19 times for all the other 496 companies in the index. So if you take all the other companies, like the forward PE is not that high. Okay, 19 is not that high. It's pretty fair. Okay, for example, if the 4 companies of the top of the S&P 500 doubled their earnings per share, so EPS, by 2030, a 15 annual growth rate, but the average price earning fell to 20 times in 2030, the return of these 4 stocks will be 4% annually. So if you have a reduction in valuation, okay, a compression of the valuation multiple, so from 33 to 20, and it still grow by 15% per year, you will have only 4% annually. So this is kind of some crazy news and thing to take in consideration, that you have some stocks that are very expensive. Okay, the market is not cheap right now. We believe it is a mistake for an investor to be distracted by what's going on in politics. So here are some few words about like the new president in the United States. Our job is to judiciously select company with the aim of being shareholder over the very long run. And if these companies increase their intrinsic value at above average rates, their stock prices should eventually follow the same trajectory, provided that they have been acquired at reasonable prices, of course. We have often held securities for more than 10 years, which is a period longer than the majority of political mandates in various Western governments. It is vital to always keep this in mind. So I think this is a very good reminder that if you're a long-run investor, if you invest on long-term, politics shouldn't matter, because you will have different presidents in the time you will hold a stock. So sometime it will be Republican, sometime Democrat, sometime it will not be people that you like, sometime it will be people you like. At the end, you don't really care, because what you want is companies that have great products, that is growing, that have great market shares, that have great numbers. And if this is all good, whoever is a politician should be good on the long run. On the short run, yes, it can have some fluctuation, and those fluctuation may be great opportunities for you. This volatility may be a great time for you to enter the market and to get some good money from it, because you will have good price, good entry point, and then the EPS will grow. Let's hope higher than the market rate, so then you can have some outperformance. Here is about their portfolio. We cannot see it because we are not. I am not a capital partner in Giverny. So the growth in profit for our portfolio group of companies is aggregate was approximately 12.1%, that representing a growth in total intrinsic value of approximately 12.7%. Okay, the historical one was around 13% annually. So 12% annually, it's good. Because if the portfolio grow by 12%, the company, not the portfolio, but the EPS of the company, the value of each company grow by 12%, it means that they are supposed to grow by at least 12% in the stock. If you didn't buy them too expensive, if you buy them at a good price and the valuation ratio doesn't move, I mean the stock should be 12% more expensive the year after. So it's a pretty good metric. Generally, there is something in common in every fund manager that has been outperforming the market, is when they bought the company, the value of the company, the intrinsic value of the company have grown more year over year than what the market can grow. So if you take S&P 500, let's say the S&P 500 will grow 10% per year, its intrinsic value. So let's say the EPS of all the company S&P 500 on average will grow 10% per year. If you invest only in companies that grow 12 or 13% per year and you buy them at a good price, not too expensive, you should outperform the market. Okay, so here's talking about Canada. I didn't pick anything very interesting here. So here's some performance, okay, compared to S&P 500 outperforming. Okay, here very important. The intrinsic value of our group of companies increased by around 13% this year, including dividend, despite the few changes made to the portfolio. We believe that this estimate of EPS growth for our company in 2024 is an adequate reflection of the economic realities. Okay, so here's like the value of their company, okay, of the growth, and here's what the market produce, and like the return that they have on the market. So the value of the company grew by 14%, and they had 29% market return in 1996. Okay, for S&P 500, 13%, and the market grew by 23%. In 2024. They grew by 13%, the market grew by 16%. For the S&P 500, the value grew by 10%, and the S&P 500 grew by 25%. It's some interesting point here to see that it will not always grow the same. For example, sometime you will have the market growing way less than the value of the company in portfolio. The value is not the price, okay? It's the intrinsic value. So this is some interesting things to see as well. The flavor of the day, okay, this is a nice part as well. I highlighted some nice things here. It is rare that buying what is immensely popular yields good result over the long run. And this is something interesting also to say, because we can see, particularly on the internet, like if you go on YouTube and so on, you have some stocks that you see that make views, okay? If you do video on Tesla, AMDs, you have plenty of stocks that have very big views potential. Popular stocks that everybody wants to know about, that everybody is looking for, everybody is looking about them. This may be, I'm not saying a red flag, but you may be careful about all of this, because generally those stocks tend to not perform very well because people have very high expectation about the earnings. They have very high expectation on the future of the stock and of the future growth of the stocks. So it may be dangerous. And also generally, when they are very famous, most of the times they are really priced as well, and you pay a big premium for this, which is not an interesting premium because it's not a premium on the quality, it's a premium on the fame, and it's not the same, and you don't really want this. Here, even more dangerous is when an asset is valued solely on the hope of selling it at a higher price to another trader rather than on the basis of a tangible economic result. So here he's talking a bit of like crypto and so on, in the sense that for him Bitcoin doesn't have intrinsic value. So the only thing of owning Bitcoin is like because you expect to sell it at a higher price in 5 or 10 years. So it's another debate. I will not enter into it in this video. I will probably not really enter into it, but yeah, it's something that stay in this strategy, and it's important for him. Here's the podium of errors. Here's some nice things as well. So the first one is Apollo Hospital. Okay, from 2007 to 2024, Apollo revenue increased by a factor of 20, and the stock has risen from about 250 rupees to 6,277. It should be considered that the rupee has depreciated by around 40% against the Canadian dollar, but we could have achieved a total return around 1,400% in 17 years despite this. So the story here is in 2007, he saw a report on television about this company. He was like, damn, those hospitals are good in India. Let's have a look if it has a stock. The numbers were pretty cool. So he was like, oh, it can be maybe interesting to invest. But the mistake that he made here is that he didn't even invest. And most of his mistake here is because he didn't invest in the company. Okay, that was the problem, or he sold a bit too early. Here for Ameriprise Financial, so it came after the spin-off from American Express. Okay, and here the stock grew. He sold. Okay, I had a hard time believing that the company had a strong competitive advantage. That's the reason he sold, because he believed that the company didn't have strong competitive advantage, that American Express was good, but this one, not the same prospect, not the same potential, and so on, not good competitive advantage. So you sell the company, which is, I think, a good decision. If you believe that the stocks that you own don't really have a competing advantage or losing it, it's better to sell, because maybe you will be wrong sometime, but at least when you're right, you know that you will not lose a lot of money because of this. And here it appears that the competitive advantage was stronger than what he thought, and the company performed very, very well. And the last one is Cintas. Okay, here it's again mistake, because he knew the company was great. He had a great analysis on this. It was in his circle of competence. He knew the business. He understood everything well. But he didn't keep it, he didn't buy it because it was a bit too expensive. So Cintas stock was trading at $26 at the time, which was about 26 times its profit of $1.02 in 2016. Despite this rather high valuation, I believe that there were a lot of potential synergies with GNK, and that possibly EPS could grow at a higher rate than revenue in the years to come. So the level of Cintas debt had increased. It seemed to be an acceptable level. So the scenario here is like they did an acquisition. He believed that the acquisition was actually smart, that it could make EPS higher, and they had an acceptable level of debt to finance all of this. So the company should be good. What unfortunately didn't materialize was to become a shareholder. I found the stock a bit expensive and decided to wait for a better price. Like the stock performed very well till 2025, okay, annual growth for more than 17%, but unfortunately didn't buy because they thought that 26 PE was too expensive. So that's the reason. While 26 is not that expensive, it's expensive, yeah, but it's not that expensive, especially for a business that you really know and that you really understand. So here it grew like 25% on an annual basis. So could be a huge outperformance for the market, but unfortunately, it missed his company. This is a worse mistake than Apollo and Ameriprise, because in the case of Cintas, I understood the company and its competitive advantages perfectly. To use a baseball analogy, it was a pitch right in the middle of my strike zone. So, yep, that's the reason. Like, he knew perfectly. You don't invest because you think it's a bit too expensive. And unfortunately, you make some make a big mistake in the sense that it will perform very well, okay? So that's what is difficult, because sometimes you have great company, PE a bit higher, but unfortunately you think, oh no, it's too high. So I think it's good to have a limit of PE. For example, my limit is 30, okay? 30, I could do an exception for a very, very amazing business to go to 33, 35, but generally it's around 30, my limit. And yeah, in this case, it happened. So here, risk management on equity investing, okay, which is a nice part. Judgment and experience can contribute more to an informed analysis of risk than panoply of algorithms. So here what I want to say is like, don't be scared because you don't understand any of the shit that you can see in financial courses, financial class, financial mathematician, theoretician, teacher, all those PhD people and so on. Because at the end of the day, you don't really need it to understand the stock market, and it doesn't lie into a panoply of algorithms. You can be great in all of this and do well. Like, I'm not saying because you're very good with numbers, algorithm, you cannot do great. No, you can do very well, but don't think that you cannot perform on the market if you're not good with this, okay? In my view, an investor's stock portfolio has 4 distinct levels of risk: portfolio diversification, the quality of the companies held, the stock market valuations paid, and lastly, the investor's own behavior. So for portfolio diversification, our experience and analysis shows that a portfolio of 20 or so security considerably reduces the risk of having too much concentration in few securities. And you can see it in a lot of investors, around 20 positions in the portfolio, because more it will be very difficult to follow everything, very difficult to outperform the market as well, and less you have potentially more risk. But you have stories of investors with 5, 6, 7 companies in the portfolio performing amazingly well. This depends as well of the business and so on. He precise that he thinks that having everything in tech, for example, may not be a very nice diversification for the portfolio. The second one is the quality of business. For him, this is the most important parameter for reducing the risk of an equity portfolio. Strong returns on equity while maintaining a low level of debt and using conservative accounting. Okay, that's what you want the company to achieve. And also, a quality company has a sustainable competitive advantage that allows it to maintain better returns on its capital over the long term when compared to its competitors. Its business model is durable and will therefore prove to be more immune to the various transformations, technological or otherwise, inherent to our capitalist world. So very important to focus on quality company. Okay, the quality of a business is very important. So you want to find quality company and to buy them at a good price and then to behave correctly with them. The stock market valuation is number 3. It is normal for a quality company to trade at a premium to the average company as measured by its price earning ratio. A security that trades 40 times earning, all other factors being equal, is necessarily riskier than other similar securities that trade at 20 times earnings. So if you have 2 companies, same growth prospect, same everything, same kind of number and so on, but one is 40 PE and the other one 20 PE. The one at 40 PE is way riskier than the one at 20 PE. So you may want to look for the one at 20 PE ratio. Being conservative in our analysis of a company's future potential and therefore its estimated value is therefore an important ingredient in reducing risk. So here, when you will do your DCF and so on, if you see, for example, that it should be you expect the EPS growth to be 15% per year for the next 3 years. Maybe don't take 15%, maybe go and take 13% or 12%. Yes, you will have way less opportunities. You may reduce your opportunities a lot by doing this, but the good thing with this is on the long run, you may shoot only on the good company. And yes, you will not invest in some companies because of this, but at the end you will be very confident about the valuation of what you bought. And if it's great company, good quality business, it will be good. Okay, so it's worth taking like this little more margin of safety, which is very important. Same, if you expect the company to have a PE in 3 or 5 years of 25, maybe put 23. Maybe again take a little margin of safety to not have. It's better to have good surprise than bad surprise. So try to anticipate those things. And number 4 is the investor's own behavior. Okay, the longer the holding period, the greater the probability that there will be a correlation between the stock market performance and the intrinsic performance of the company's held. Okay, his average holding period in Giverny is 8 years. So don't start panicking because after 6 months the stock is not going in the direction you want, because it's not going what you expected and so on. Okay, he's holding for at least 8 years. So yeah, this is something very important. Investing in the stock market is like running a marathon. And to win a marathon, the first rule is to run in a way that will allow you to finish it. So this is important to understand. Like, you're not trying to go fast, you're not trying to arrive like fast and first. You want to at least arrive first. You want to be sure that you will arrive, and then you want to improve if you can. Here's the appendix. I think it's few nice things. Okay, it's about his investment philosophy. So here's a few points. First, we believe that over the long run, stocks are the best class of investment. Second one, it is futile to predict when it will be the best time to begin buying or selling stocks. 3. A stock return will eventually echo the increase in per share intrinsic value of the underlying companies, usually linked to the return on equity. 4. We choose companies that have high and sustainable margin and high return on equity, good long-term prospect, and are managed by brilliant, honest, and dedicated and altruist people. We avoid risky companies, non-profitable business with too much debt, with a lot of cyclicality, and or run by people motivated by ego instead of genuine stewardship. Once a company has been selected for its exceptional qualities, a realistic valuation of its intrinsic value has to be approximately assessed. The stock market is dominated by participants that perceive stocks as casino ships. With that knowledge, we can then sometimes build great business well below their intrinsic value. There can be quite some time before the market recognizes the true value of our company, but if we were right on the business, we'll eventually be right on the stock. Okay, so two things to differentiate: the stock on one side and the business of the company on the other side. Don't try to go on super risky things. Like, I personally do the same. If the company is not profitable, is automatically out of my watch list, automatically out. I'm not interested in it. Experience and common sense teach us that an investment philosophy based on buying shares in companies that are undervalued and holding this company for several years will not generate linear returns. Some years, our portfolio will have a return that is below average. This is a certainty that we must accept. So yeah, as we said a bit at the beginning, you will not outperform every year. You will not have great performance every year. You may have also a year with bad performance, but it's normal, okay? On the long run, it should be good, but on the short run, doing this, you may have some surprise, so you need to be strong enough to accept this, and you need to know it will happen. If you don't accept this, maybe you should invest differently or invest in something else. When we see stock price as what other people believe the company is worth rather than the real value, at least in the short term, this fluctuation become our allies and in our noble quest for creating wealth. Benjamin Graham liked to say that the irrationality of the market provides an extraordinary advantage to the intelligent investor. And that's the end. That's all what I highlighted here. I hope you liked it. I really enjoy reading those letters from capital managers and so on, because when they beat the market, there is actually some great lesson in it. You have a lot of things that you can learn, and the good thing is they really share value. They really share some good views, some things that you can use in your portfolio. So yeah, I will recommend you to read François Rochon one, and to find other hedge funds that have a letter to shareholder as well that outperform the market, because you may have some very interesting news to get in, and maybe also some great investment ideas that can come from those things.